Rogers Communications, Q2 2026. The numbers are in, and we are looking at a print that honestly left the market scratching its head in early trading.
Yeah, it's a complicated one.
Total service revenue actually beat expectations, up 8% year over year to $5.1 billion. Adjusted diluted EPS sits at $1.15, which is up 1%. And management is reaffirming their 2026 guidance across the board. So they're calling for a 3 to 5% increase in total service revenue and projecting, 4.1 to 4.3 billion in free cash flow.
Right. The core guidance is totally intact.
Exactly. But you stare right at the income statement, and the very first thing that hits you is a reported net loss of $665 million.
Yeah, and the divergence there, I mean, that is the entire story of this quarter. You have this massive reported net loss sitting directly alongside an incredibly strong free cash flow generation.
Right.
They brought in $982 million in actual cash during the exact same 90-day period. So if you just read the headline net loss and dump the stock, you are completely missing the underlying mechanics of this massive corporate transformation.
Okay, let's unpack this. Because when you are scrolling your feed and you see a $665 million net loss from a bedrock Canadian telecom, your first instinct is to hit the panic button.
Oh, absolutely.
But when you strip out the noise, look at the adjusted numbers, and really trace how nearly $1 billion in actual cash just flowed through the door, it paints an entirely different reality.
It really does.
To understand how they generated that cash, and more importantly, what they are about to spend it on, we have to look straight at the core engine of the business first, which is the wireless segment.
Yeah, and the mechanics of the wireless segment right now tell a pretty fascinating story about the Canadian consumer. Service revenue here was essentially flat at $1.99 billion. They brought in 40,000 mobile phone net additions, with 22,000 of those being postpaid.
Okay.
But the standout metric, the one that really protects their moat, is the churn. Postpaid churn actually improved by 6 basis points, down to 0.94%. Yeah. In telecom, getting your churn under 1% means your base is locked in tight. However, the cost of keeping them locked in is definitely rising. Mobile phone ARPU, so average revenue per user, it dropped $1.20 year over year, down to $54.25.
So wait, they are keeping you as a customer, but they're squeezing less money out of your monthly service plan.
Exactly.
Yeah.
We are seeing really intense competition right now because the broader macro environment has shifted. The population growth rate in Canada has normalized,
Right, fewer new people entering the country.
Exactly, which means there are just fewer new, unattached customers entering the market to easily acquire. The pie isn't growing as fast. So providers are essentially fighting a zero-sum game over the exact same pool of subscribers.
Which forces them to discount.
Right. That leads to a highly promotional environment where carriers are discounting base plan just to get you in the door or to keep you from leaving, and that drags down the average revenue per user. But here is the piece of financial engineering you really have to pay attention to.
What's that?
Despite the ARPU drop, the wireless segment's adjusted EBITDA actually increased 1% to $1.31 billion. And their EBITDA margins expanded by 70 basis points to a very healthy 66%.
It's like an airline dropping their base ticket prices just to get you on the plane, but making more money overall because everyone is upgrading to premium economy and buying, in-flight meals. The core service itself is cheaper, but your ancillary spend more than makes up for the discount.
That airline analogy works perfectly for the top line, for sure. But the difference here is the lock-in factor. I mean, airlines do not enjoy a 0.94% churn rate.
Very true.
Rogers is making up for the flat service revenue through higher equipment margins. The report documents a really clear shift in their product mix toward higher value devices. Like, you might not be upgrading your phone every 12 months anymore, but when you finally do upgrade, you are buying the $1,500 premium model.
Ah, I see.
So Rogers takes a hit on your monthly service fee to keep you happy, but they expand their margin on the hardware side of the transaction. And once they get that premium device in your hand, tied to their network, that 0.94% churn rate proves you really aren't leaving.
I have to push back on how sustainable that is, though. I mean, you can only expand your margins while your actual revenue per user shrinks for so long, right?
Sure.
You can only sell someone a higher tier phone every few years. Eventually, if competitive intensity keeps compressing that monthly ARPU down to $50, then $45, the equipment margins simply won't be able to cover that gap forever.
Well, management would argue they're already ahead of that curve, which is why they are hyper-focused on base management and bundling. They know they can't rely solely on hardware upgrades.
Right.
That is why they're layering on new 5G Plus plans with priority network access. And rolling out a satellite-to-mobile coverage feature for U.S. roaming. They're trying to offer premium, differentiated network features to justify the ecosystem. The goal is to make the network itself feel indispensable, even if the base ARPU takes a temporary competitive hit.
But this strategy of sacrificing base service revenue to juice operational margins, it isn't isolated to wireless. You see the exact same margin-squeezing playbook happening over in cable.
Oh, definitely. The cable segment is essentially a masterclass in managing a mature, melting ice cube. Cable service revenue and adjusted EBITDA both grew by just 1%. Adjusted EBITDA margins ticked up slightly to 58.4%.
Which isn't huge growth.
No, not at all. The underlying growth was entirely driven by 17,000 retail internet net additions. They desperately needed every single one of those internet additions to offset the bleeding in their legacy services.
Right, because they lost, 22,000 video subscribers?
Yeah, 22,000 video and another 26,000 home phone subscribers in this quarter alone.
Wow. The structural shift is undeniable when you look at those numbers side by side. Cable is essentially an internet-only growth story now. The traditional TV and home phone bundles are just dead weight.
They are secular decliners, absolutely. But despite that massive erosion in legacy products, cable capital expenditures notably dropped by 9%.
Yeah.
This is where operational execution directly impacts the free cash flow you see on the balance sheet. A really specific driver of that decreased capital expenditure highlighted in the report is consumer behavior. You, the customer, are increasingly choosing to self-install your new products.
Yes, if you are digging into the operational metrics, here's the detail you really need to notice. Self-installs. They have essentially IKEA-fied the telecom setup.
Exactly.
They mail you the router, you plug it in yourself using an app, and they no longer have to pay a technician to roll a truck, burn gas, and spend an hour crawling around your living room.
And fewer technicians driving trucks translates immediately to the bottom line. Historically, a truck roll could cost a telecom provider anywhere from $150 to $200 per visit.
Which adds up fast.
Very fast.
Yeah.
You eliminate tens of thousands of those, and you fundamentally lower the cost to acquire and activate a customer. And while they are banking those savings, they are simultaneously upgrading their DSCSI's 3.1 platform to DSCSI's 4.0. and rolling out mid-split technology across Ontario and Eastern Canada.
Okay, let's break down mid-split technology because that sounds like heavy jargon, but the mechanics of it are actually crucial for understanding how they are saving money here.
Yeah, it is entirely about capital efficiency. A traditional coaxial cable going into your house has a massive amount of frequency dedicated just to downloading data because historically, you just downloaded web pages and watched Netflix. Very little frequency was dedicated to uploading.
But now you are on Zoom calls, you are uploading massive video files, you are gaming online.
Right. So mid-split technology essentially allows Rogers to electronically reallocate the frequencies inside that existing copper wire to massively boost your upload speeds. The mechanical genius here is that they can deliver fiber-like symmetric speeds using the cables already buried in your yard.
Saving them the astronomical cost of having to dig up the street to lay new fiber optic lines.
Exactly. They are improving network capacity while drastically lowering the immediate installation and infrastructure costs. They are turning a slow-growth segment into a highly optimized cash generator.
Which they need. Because you cannot spend $4.35 billion in cash on a sports team without something breaking on the balance sheet. And they need every single dollar of that steady, predictable cash from cable and wireless to fund what is happening over in the media segment. Let's talk about the big swing, the MLSE monopoly aboard.
The numbers in the media segment are honestly dramatic. Media revenue exploded up 53% year over year to $1.15 billion. Adjusted EBITDA shot up by $61 million.
That's a massive jump.
Yeah. Now, a substantial chunk of this is driven by the fact that they began consolidating Maple Leaf Sports and Entertainment, so MLSE, onto their books starting in July 2025. But there's also a very healthy 13% organic growth rate hiding in there.
Which is pretty impressive.
It is. That organic growth is led by the Toronto Blue Jays, who saw attendance hit over 95% of capacity at the Rogers Centre, which is their best second quarter attendance since 1994, by the way, combined with incredibly strong local sponsorships.
But the real story here is the transaction itself. Rogers agreed to buy the remaining 25% minority stake in MLSE from Kilmer Sports for $4.35 billion in cash, a deal they expect to close in the fourth quarter. And here is the crucial accounting reality that ties the entire earnings report together. Wow. This deal triggered a massive $1.034 billion non-cash loss due to the revaluation of the MLSE put liability.
Yeah, we really need to explain the mechanics of that put liability because it is the sole reason for the headline net loss of $665 million we discussed at the top of the show. A put liability is essentially a financial loaded gun held by the minority owner. Kilmer Sports had the contractual right to force Rogers to buy their 25% stake at a certain valuation. Previously, Rogers had this liability penciled in on their balance sheet at $3.3 billion.
Okay.
But when they actually sat down at the table and agreed to buy it for $4.35 billion in cash, accounting rules dictate that they have to mark that liability to the new market price immediately.
Right, so that $1.034 billion difference between the old penciled-in value and the new agreed-upon purchase price, that has to be recorded as a loss on the income statement today, before the cash even leaves the door in Q4.
That is exactly the mechanism. It is a paper loss driven by a change in asset valuation. It does not affect the $982 million in free cash flow they generated this quarter from actually running their cell towers and cable networks.
But it does reveal management's master plan.
It does. They are consolidating 100% of MLSE. That means they will outright own the Toronto Maple Leafs, the Raptors, Toronto FC, the Argonauts, and Scotiabank Arena. They are taking that portfolio and putting it alongside their existing ownership of the Blue Jays, the Rogers Centre, and the Sportsnet Broadcasting Network into one massive mega portfolio they're calling Rogers Sports.
Right.
And their stated intention is that once the super portfolio is fully consolidated, they want to sell a minority stake to third-party investors to unlock value.
Let's expand on this monopoly board metaphor a bit. They aren't just buying sports teams. They are vertically integrating Canadian attention. They own the team on the ice. They own the arena the team plays in. They own the broadcast network the game airs on. And they own the 5G network and the smartphone you use to stream it.
It is vertical integration on a scale rarely seen in modern media. Management believes there is a significant premium to be extracted by packaging these assets together rather than having them fractionally owned across different holding companies. Private equity and institutional investors are starving for live sports assets right now.
Because it's DVR-proof.
Exactly. Live sports are the only DVR-proof appointment viewing content left on television. Rogers is betting that Wall Street or private equity will pay a massive premium to get a slice of a fully integrated sports and media monopoly in North America's fourth largest market.
I have to question the financial engineering at play here, though. I mean, you are buying the final slice of the pie from Kilmer Sports at a massive premium $4.35 billion in cold, hard cash, just so you can repackage the entire pie and try to sell a new slice to someone else.
That's a bold move.
What if the market doesn't value this super pie as highly as management expects? We are seeing softness in the broader media advertising market, which Rogers actually flagged as a risk in this very report. Relying on sports franchise valuations to just go up in a straight line forever is a massive assumption.
It is a significant risk, and to management's credit, they openly acknowledge it. The monetization of these sports assets requires league approvals, which are never a rubber stamp. The NHL, the NBA, Major League Baseball, they all have incredibly strict, archaic rules about ownership structures, debt levels, and who can own what.
Oh, for sure.
Furthermore, if the broader macroeconomic environment cools, finding a buyer willing to pay the premium valuation Rogers expects for that minority stake could prove exceptionally difficult. If they cannot sell that stake, they are left holding a very expensive bag that they funded by draining cash from their telecom operations.
Which brings us perfectly to how they are actually funding this. Executing a $4.35 billion cash buyout while running a national coast-to-coast telecom network requires immense capital discipline.
Right.
So let's look at the balance sheet, capital allocation, and the broader macro risks.
Okay, so the liquidity profile is stable. Available liquidity sits at $6.1 billion. Their debt leverage ratio is currently 3.8x. But the metric that jumps completely off the page for anyone modeling this company is their capital intensity.
Yeah, the drop is wild.
It plummeted 350 basis points down to 12.4%. That is the lowest capital intensity ratio Rogers has reported since the first quarter of 2008. Total capital expenditures were $695 million, which is down 16% year over year.
Okay, the lowest capital intensity since 2008 sounds great for generating that $982 million in free cash flow today. But in telecom, network dominance is everything.
Right.
If you stop building, your competitors catch up.
Right.
Are they starving the network? We are talking about the rollout of 3,500 megahertz and 3,800 megahertz spectrum for 5G and expanding fiber to the home, you can only defer those projects for so long before network quality suffers. Are they artificially suffocating the telecom side of the business, the side that actually generates the cash just to fund their sports empire and manage their debt load?
I wouldn't call it starving the business, and management would aggressively push back on that premise. They would point directly to the fact that they were just ranked the best 5G plus network in Canada by Lout, and they are currently rolling out a cloud-native network technology with Nokia and AWS to add a massive layer of redundancy and resilience.
Okay, so they are still investing.
They are. They're betting that their past capital cycles were front-loaded heavily enough that they can afford to coast on a 12.4% capital intensity today without you, the end user, noticing a single dropped call or a dip in download speeds. However, they did explicitly cite regulatory decisions and competitive intensity as reasons for deliberately pulling back on broader capital spend. Back in April, they actually updated their 2026 CapEx guidance downward to $2.5 to $2.7 billion, down from the $3.7 billion they spent in 2025.
We really need to talk about those regulatory headwinds because the CRTC is actively changing the rules of the game, and it is not making life easy for the major carriers.
No, the regulatory environment is becoming downright hostile to traditional telecom margins. A major factor here is the CRTC's recent prohibition of fees that act as a barrier to switching cell phone and internet plans. Back in March, the CRTC issued a policy banning activation or modification fees, which officially went into effect in June.
Wow.
Furthermore, they are demanding carriers show cause as to why other specific administrative fees aren't in violation of this new rule.
Think about the psychology of that for a second. If you are sitting at home and your carrier charges you a $50 activation fee to switch to a competitor, you just stay put. It is manufactured friction.
Absolutely.
The CRTC just eliminated that friction. That makes Rogers' current 0.94% churn rate even more miraculous, but it also makes it incredibly vulnerable. If churn suddenly spikes because switching to a cheaper promo rate is entirely free, Rogers has to spend massively on marketing and hardware subsidies to replace those lost customers, which further degrades the very ARPU we discussed earlier.
It creates a vicious negative feedback loop on their core service revenue. Combine that switching fee ban with the CRTC's Online Streaming Act, which recently introduced a new 1.55% financial contribution requirement for Canadian broadcasting revenues, and you see a regulatory environment that is actively compressing margins on every traditional business line Rogers operates.
It's squeezing them from all sides.
Exactly. Honestly, this regulatory pressure is likely a major foundational reason why Rogers is leaning so heavily into sports ownership. MLSE is an asset class they can control with an impenetrable moat that the CRTC cannot easily regulate. You can regulate switching fees, but you cannot regulate the consumer demand to watch the Maple Leafs play on a Saturday night in Toronto.
But you still have to pay the players, maintain the stadiums, and service the massive debt you took on to buy the team in the first place. The tension in this earnings report is just palpable.
It really is.
On one hand, you have a highly efficient, cash-generating telecom business that is facing intense regulatory and competitive headwinds, slowing its capital investments to the lowest levels seen since the Great Financial Crisis. And on the other hand, you have a massive, capital-hungry sports and media conglomerate being built through multi-billion-dollar buyouts and high-wire financial engineering.
It forces you, as an analyst or investor, to look at the entire corporate structure and ask what kind of company this is evolving into.
Right.
The traditional telecom model is highly predictable. You build a network, you acquire subscribers, you collect a steady stream of monthly recurring revenue, and you pay a reliable dividend. The sports and entertainment model is the exact opposite. It's highly variable, reliant on unpredictable team performance, fluctuating broadcast rights, fickle advertising markets, and discretionary consumer spending.
Yeah.
By combining these two vastly different operational models at this unprecedented scale, Rogers is fundamentally altering its risk profile.
Which leaves you with the ultimate question to consider when evaluating your portfolio tomorrow morning. If Rogers successfully executes this sports monetization strategy, if they consolidate MLSE, package it with the Blue Jays, and sell a minority stake at a premium, how should the market value this stock?
That's the billion-dollar question.
Does it remain a traditional, dividend-paying telecom utility constrained by the lower multiples of its peer group? Or does this unique vertical structure mean it deserves to be priced as a premium entertainment conglomerate? And perhaps more importantly, will the dividend investors who traditionally hold telecom stocks tolerate the massive volatility that inherently comes with the sports world? Make sure to follow the deep dive feed for your daily earnings coverage. That's the recap for today.